Is Kevin Lings, economist at Stanlib, to preview the MPC decision on local interest rates. Kevin, welcome to Power Lunch. Thanks for joining us. It's going to be a flatliner, isn't it?
It looks that way, Lindsay. I think that's where the general expectation is. Obviously, the decision is becoming more difficult. I think if you go back to the earlier decisions in the year, I think it was quite easy for the MPC to conclude to leave rates unchanged. But I guess with inflation a little bit lower and expected actually to go lower over the next couple of months, plus the growth rate slowing locally and internationally, they will have to debate the prospect for an interest rate cut. I don't think they're going to be able to ignore that as a discussion point. But I think at this stage they probably conclude to leave it alone. What they'll be watching for going forward is not just what happens to inflation. I think the Reserve Bank will accept that inflation is reasonably under control at the moment and probably likely to remain there. I think they'll focus quite heavily on what the growth dynamics are in South Africa. And obviously, if the growth rate weakens substantially over the next couple of months, come September, there's a distinct possibility that they cut then. So for the moment, I would say unchanged, but they will, I think, in the statement, allude to that prospect that they could well cut in the future.
Okay, let's indulge me now with this fantasy. You're a member of the committee. You're a member of the Monetary Policy Committee of the South African Reserve Bank. You're all sitting around the table. You've got tea and biscuits in front of you, and Jill Marcus, the governor, stands up and says, "Right, Lings, what do you think?" And you've got on a piece of paper in front of you, you've got inflation, you've got the rand exchange rate, you've got GDP growth, you've got consumer confidence, which came out this week and shocked to the downside. You've got PMI, which is below 50. You've got retail sales, household debt, and also political pressure. How do you rank those when you give your presentation to the governor?
Well, what sort of biscuits do we have, Lindsay?
Ginger nuts.
Okay. In terms of the ranking, you obviously got to focus mostly on the inflation parameters because that remains the central objective of the Reserve Bank. And so you would be looking at what that prognosis looks like. And in the shorter term, you would be telling the governor that inflation can move basically to around about 5%, maybe slightly lower. What I would be telling the governor, though, there are two risks that we need to be aware of. The one is the international oil price. And when we look at oil prices, they've moved up quite a bit in the last couple of weeks. And if you look at the petrol price, the under recovery now, it sits, I think, at about 40 cents, 43 cents a litre. That means in the next couple of months, we're going to see petrol price going up. So it's not something we can ignore. So we've got 2 petrol price reductions in the last 2 months. That helps inflation. But I'd be telling the governor that we've got to watch this oil price can upset the inflation outlook. And the second thing is what's happening to international corn prices in the US or international maize prices. They've jumped up very, very sharply. And we're starting to now have to price in the possibility that food inflation drifts higher towards the end of the year. Whereas at the moment, food inflation has come down nicely. It sits at 6%, but we've got to be cautious about food inflation going out. So I would tell the governor, I think we're in a reasonable space in terms of inflation. I think there's little risk that we're going to break substantially out of the 6%, but we mustn't become too complacent about inflation. And then in terms of growth, have a look at the retail sales number that came out yesterday, 6.4%. It's telling us that the consumer is still actually out there doing reasonably okay, and that while we see the economy slowing, from a consumer point of view, it's actually not slowing that dramatically. If we cut interest rates, what do we hope will happen as a consequence of that cut? And we'd have to conclude that probably the consumer goes shopping a bit more, maybe imports a little bit more, and that import then worsens our trade numbers, worsens our current account, puts our rand at a little bit more risk. So by cutting rates, we're building in a little bit more risk into the economy. For what sort of gain? And maybe we need to just watch and make sure that when we cut rates, it's really something that's required because rates are already very stimulatory in South Africa. So I think they can hold off and wait till September.
So what you're saying is actually that the interest rate cut on its own, taken in isolation, is almost like an impotent tool given all the factors that you've just outlined.
Well, when you cut rates, there's always some benefit. There'd always be some stimulus, some confidence gain, some positive effect, no doubt. But how much of an effect, and I would question how significant it can be under current circumstances. We've already got the lowest interest rate since 1974, and we haven't seen a huge effect. So what's 50 basis points going to do? We've got to recognize on the other side of it that our current account sits at 4.9% of GDP, let's call it 5% of GDP. Let's round off the numbers. That's 150 billion rand outflow on our current account. We have to get a similar inflow to balance that. If we keep cutting interest rates, are we going to attract 150 billion rands worth of inflows to support our current account? And that becomes more risky. So we're adding more risk to our system for what sort of gain? I'd rather see a focus on what's happening to government initiatives, infrastructure initiatives, regulation of business, what's happening with industrial policy, competition policy. I'd rather see much more focus on those aspects to get the economy going than an out-and-out focus on ever lower interest rates. There's only so much interest rates can do.
Yeah, you're quite right. And there's only so much the Reserve Bank can do, given that the only thing that they have within their power to do is either leave rates unchanged, raise them, or cut them. And you were talking about that, you'd say to the governor about the oil price and the food prices in the United States of America. I mean, I'm looking at, we're going to be speaking to a chap called Chris Sturgis later on from the JSE actually about the situation for the maize crop in the United States and its impact on the SAFEX maize futures. I mean, in a matter of days, this thing has gone from below 2,000 Rand a tonne for our local maize up to 2,500, close to 2,600 Rand a tonne in days. I mean, that's a massive, massive impact, and not just for maize itself in isolation, but also in the food chain. And the oil price from below 90 up to 106. Again, with the Rand quite steady, it still means that we are going to get a rise in petrol prices in the next couple of months, doesn't it?
Very much so. And let's just go back to that maize effect. It's phenomenal increase in a really, really short period of time. It may turn out that it's a little bit overdone. In other words, when you look at how bad the drought is in the US, it is having an effect. But from my calculation, the US could still end up this year with the third biggest corn crop or maize crop they've ever had. So it's not as if the US is facing a massive disaster. They're facing certainly a drought and an impact on crop production, but not a complete disaster. So you may find that the maize price settles down in a couple of weeks, couple of months' time as we kind of get a better sense of what the crop in the US could turn out to be. But would you be cutting under current circumstances, or would you wait to see perhaps how that pans out? And if we fast forward to September, we've got more information about the oil effect and the maize price effect, plus we've probably got better information about how the economy has performed through the winter season and just how weak the local economy is, and then maybe we make a better decision in September as to whether or not we can cut. There's no doubt that she has a cut as a policy option. The Reserve Bank can justify an interest rate cut. It would not be a shock in terms of how the parameters are panning out. But what we do know is that you can't cut forever. So when do you use those interest rates cut to the most effect? And I would argue that maybe in a couple of months' time, they could prove to be more effective if the economy is slowing more by then.